Hey folks, it's Wesley Eves with A&I Insurance Services. I want to come to you again with an update on the state of the property insurance market. Um, Last time I filmed one of these was a couple of months ago. It was sometime in late June. You may just now be seeing it. We're sending out links to that information as renewals come around, and your renewal may just be coming around. But I want to talk about some things that have happened since then. We've pretty much come through the summer cycle. The summer cycle in insurance is a result of the summer cycle in the home buying process. So there have been some updates in that time period that I want to just talk to you about real briefly. Um, Here's what's going on. The rate increases that we've seen this year, uh, honestly unprecedented. I've been doing this since 2001, and I have never seen a year like this. Uh, I've talked to several people who have been in the industry longer than me, and they're in the same boat. This is kind of unprecedented. I hate that word, but it's the word that's being thrown around. It's unprecedented. And here's some things that have happened since June. In fact, just yesterday, no, not yesterday, but a couple of days ago, we got news that one of the major home insurance carriers in the country was laying off 11% of its workforce. They're doing that in an effort to make their business model more efficient, reduce their overhead, to try to get back to profitability. Um, I address some of the things that are driving a lack of profitability in other videos, so I'm not going to rehash that. But with that said, with them making major layoffs, there's a decent chance that you're going to see that kind of have ripples out into the rest of the market. Other companies may do the same thing. Uh, but that particular company had already completely shut down new business in some very populated states. They had slowed new business in other states, and they slow new business, not just that company, but all these companies, they slow new business in a variety of ways. Um, some of the ways that they slow new business are through much more strict underwriting requirements, where not as many people qualify. Uh, I've seen some companies do, it seems kind of crazy, but they'll say, well, if their water heater is in the attic, it has to be under 8 years old. Like that's something that will eliminate a lot of new business right there. There are many, many water heaters out there that are in attics that are older than 8 years. And so that's just one small example. I mean, there are others as well. There's other tactics and things that they do to limit things. Some have reduced the age requirements on their roof. In other words, it's got to be a younger roof. The roof can't be as old. In order to write a new policy. They will keep you insured beyond that particular age of roof, but in order to do a new policy, it has to meet a lower age threshold. Others have raised rates for new business. That slows new business. And the reason they're doing this is because capacity has been reduced. Now, how do you reduce capacity in insurance? The way that is done, or how capacity is restricted in insurance, they all have to have a particular amount of money on hand that they can't use for anything else. It's just cash reserves. It's basically an emergency savings account that they have to be able to maintain for every dollar of risk. So let's take a typical home. Let's just say, just for easy numbers, that the home is a $300,000 home. That's for the coverage on the house. There's $150,000 of personal property coverage on that home, and then there's liability coverage on that home of another $300,000. The total potential exposure, now not in one event obviously, but the total potential exposure on that is $750,000. Now for that particular policy, let's just say it's $3,000, just to make an easy number, right? So that's 1% of the total potential risk out there that they're bringing in. Now, of that, a large portion of that, 60 to 70%, is probably going to pay out of the claim. So they're working with anywhere from 30% to 40% of that to run the business otherwise. and that has gotten dramatically eaten into. So they've got to raise rates to be able to bring in more capacity, more cash reserves, because as inflation has hit and insurance values are going up, they have to be able to raise cash reserves along with that. And when you're on the thin margins that they're on, that's a difficult thing to do. I mean, think about your own personal budget. As inflation has eaten into your personal budget, it's harder to have savings. It's harder to save money at the end of the month when inflation is happening in your own personal budget. So apply that to the property insurance company, and that's kind of the mechanics of how it works. Now, when they raise rates, what happens? It causes people to shop around and look for, kind of like water finds the lowest level, it causes a lot of people to try to find the lowest level as well. That forces people to move around to companies who still have some capacity. But as a lot of people move over to those companies, that capacity gets reduced as well. And so those companies that were taking on new business now are reaching their limit and saying, whoa, we have to slow things down. And again, then they go and slow it down through underwriting criteria, raised rates, or just completely hitting the pause button. Seems like every couple of weeks I get a notification that a carrier that we had available is now pushing the pause button, or they are updating their underwriting criteria to become more strict, or they are raising rates on new business. And those things are happening on a regular basis. What that does is when they take capacity off the table is it reduces competition in the market further and further. And so you have more people competing for fewer spots. So as supply dwindles, demand for the supplies that are out there at a decent rate, people are competing for them. They're getting sucked up. And that's causing more and more companies to reach capacity and then have to pull back. So here's what we're doing. Here's our main focus right now. Like I mentioned, we are reviewing every single renewal. And again, that's unprecedented. We haven't had to do that in the past, but we are reviewing every single renewal. And our focus is on two things, just like it's always been, trying to find you the best price with the best coverage. The worst thing we could do for you would be to put you with a company that's at risk of becoming insolvent, selling you a policy to a company that can't back up its commitment to you to pay a claim. We want to make sure that if we provide you with an insurance policy, that it's with a solid company who has claims paying ability, who is going to be there. So we're not going to necessarily, there's a lot of cheap companies who are on the verge of insolvency. Not going to put you with them. I'm going to find you a solid company that is reputable, that is going to be around, that can maintain their financial ratings, and has the cash and the resources available to be able to pay claims. That's our commitment. That's our goal. That's what we're looking for when we go and review all of these. So I know that I got a little bit long-winded in this. I doubt you geek out on insurance like I do, but I hope you found it valuable. If you have questions and want to talk, hey, give me a call, and I'll be happy to talk with you about things and how it affects you directly, because that's obviously where the rubber meets the road. We want to make sure that we are providing you with the best value that we can find in the market for your insurance dollars. We appreciate you. Thank you very much. Have a good day.